Yes, folks, Elizabeth Warren wants the Fed to cut rates tomorrow. We'll talk about that. How about Case-Shiller and home prices falling? Talk about lessons from the 1960s. We obviously have the we have the 53-year spreadsheet that goes back to 1970s. What are some things we can learn from the 60s so that we don't repeat the 70s? Talk about some housing bears, Mark Zandi being one of them, who thought we could, if we had a recession, go down 10% or more. What are they saying now? And of course, we will talk about UPS, Redfin, and the average home buyer. Folks, let's get into it. It is Tuesday, January 30th, and this is how we're going to make some money today. Let's talk about Elizabeth Warren. What is Elizabeth Warren doing? She has sent a note, a letter, a proposal, whatever you want to call it, to Jerome Powell in the Fed. It says, in no uncertain terms, cut astronomical rates to ease housing pressure this meeting. Alrighty, folks, you have been on my channel for a while. We have often said the government is great at stoking demand, but they are not helping supply. So I want to ask you, let's just pretend for a moment that Jerome Powell and the Fed is swayed by Elizabeth Warren's request to cut these astronomical rates. I ask you, what happens to supply and what happens to demand? Elizabeth Warren's theory is interest rates are hurting home buyers. It is hurting the average American. Well, I suggest, given the demand-supply imbalance that we already have, that lowering rates a quarter point, maybe a half, because it's unclear what Elizabeth really wants, would do nothing to increase supply, but boy, oh boy, would it increase demand. So I personally think that if Elizabeth Warren got what she wanted, she would not get what she wants, if that makes sense. She would get more demand, she would get higher prices, and it would be all kinds of bad. So much so, did you know, in the last 6 weeks, the average new home buyer, frankly, home buyer in general, but this article was about new home buyers, the average new home buyer has seen an increase in buying power of $40,000. What does that mean? Folks, rates are down. So if you hold constant the payment, you can now afford a home that is costing $40,000 more. So I ask you, if rates go down another half point, what does that do? Well, now it's $60,000 in additional buying power with no inventory and some big problems. So again, I don't see what Elizabeth sees, but maybe it gets headlines. Maybe it gets her in front of the cameras. I don't know. Doesn't make sense to me. How about Case-Shiller? Again, folks, we talked about this over the weekend. Case-Shiller, home prices were coming out. It is old data, but data we got to talk about nonetheless. It does show that month on month, home prices are down. Now, again, what does that mean? These are down in November. Anybody remember November? November was that month where we saw 8.03% mortgages. Do we have 8% mortgages today? Is there anything about the market today that resembles November? And the answer is, of course, no. But let's get behind the numbers. What are they? Let me get them. Home prices month on month fell 0.2%. That is the first month on month drop, I think, since January. Year on year, which is obviously the metric I care about, year on year the metric is up 5.1%. It should be noted that the year on year number is up sequentially. So even though we are down monthly, when you look at the year on year sequential growth, we are up 5.1%. That is not a crash. and by any means. If we go behind the numbers to the city level, we do have some numbers that are negative. Seattle was negative 1.4%, and San Francisco was negative 1.3%. The highest increase was in Detroit. I think that makes 2 months in a row. Detroit was up 8.2%, pretty strong growth. San Diego, wow, San Diego up another 8%, pretty crazy. All-time highs. Yes, folks, even though we were down 0.2%, we have several cities with all-time highs. Miami, Tampa, Atlanta, Charlotte, New York, and Cleveland. So again, lots of stuff going on. Most of that in the southeast of the country. So again, that is Case Shiller. It is November. Again, frankly, nothing like what is going on in the market today, but nonetheless, there you go. Let's talk about lessons from the 1960s. We've done a lot of research, a lot of talking about the 53-year spreadsheet. You can get it on the website. It is right there. There's a lot of talk about the soft landing and lessons from the 60s. The biggest lesson I took from an article is when you have inflation on the run, when you are beating inflation, when inflation is coming in, don't give up. You have to kind of step on the neck and truly, truly break inflation. You can't take your foot off the gas, if you will, or foot off the brake when you think you're there, because inflation is nasty and it will come back. This is why I think it is interesting when you look at the lessons from the 60s, and of course we go back to point number one. Elizabeth Warren wants lower rates now, like tomorrow. So I ask you, if we got lower rates, demand went up, I think it's fair to say prices would go up. If prices go up, rents probably go up, and we reignite inflation. So I ask you, how does that fix anything? We should go back and study history. Of course, history doesn't repeat, but it rhymes. I think there's a lot of lessons from the 1960s. How about Mark Zandi? Mark Zandi is a very well-known housing forecaster. He is often quoted on CNBC, Bloomberg, Resi Club, and the like. Mark Zandi was very negative on U.S. housing in 2023 when he forecasted 2024. Again, he was forecasting things like if we had a recession, the median home price in the U.S. could fall 10% or more. Well, Mark has had he is reevaluated. And now essentially Mark Zandi is calling for the next 2 to 3 years to be flat. So he has walked back his bearish tone. He thinks the lock-in effect is stronger than he anticipated. He expects it to be flat for 2 to 3 years, frankly, as I have shared repeatedly. And then finally, rising wages, lower rates will eventually impact affordability. Folks, this is what you and I have been talking about. There are 3 levers to affordability: wages, interest rate, and price. A lot of people go back to the 2008 crash and make it all about price. As I've shared for well over a year, that is a mistake. Unfortunately, we are on a slow grind towards better affordability. So much so we can talk about Redfin. What is Redfin saying? Redfin is saying that they expect housing transactions to go up only modestly to about 4.3 million, or about 5%. I think that is fair. I think we're going to be in the low 4s for sure. They do expect prices to go up 1%. So folks, it does feel like the experts have finally come to where you and I are, in that we will be flat for years. This is not going to fix affordability with some quick price drop. It's just not coming. It's not there in the cards. And then we'd be remiss if we didn't talk about UPS, United Postal Service, the brown trucks. Man, ugly, ugly earnings report, talking about shipping volume down domestically and international. They talked about needing to whack $1 billion in costs. In order to get on that track, they're going to lay off 12,000 folks. So again, folks, a lot of stuff going on out there. Again, keep doing the work, know it is possible. And then lastly, we've got to congratulate somebody who got a couple of deals. Keto, congratulations. You have, I think we're going to see you in Vegas. Congratulations on 2 more cards. They will go out in the mail. Folks, if you have closed a deal and one rental at a time has helped you, and I have not given you a public shout out on the daily financial news, please remind me. I do all of this myself. I don't have a team. So if you've sent me a note and I've not given you a public shout out, please remind me. I will send you a card, whether it's a black card or a golden ticket like this one. Just want to keep track of what we're doing. I hope you guys have a great day. Keep doing the work. Keep being awesome. Keep networking. And of course, have an amazing day. Bye.